So very good morning, everyone. Good morning, guys. Yes. So shall we begin? Yes. Right. So and I hope you guys have revised whatever we've covered till date, because it's very important for us. In today's session, we are going to connect whatever we have studied till now. You might be wondering, sir, why are we doing these two chapters that are, the previous chapter that is not even a part of the study material. Today we will connect all the dots. This lecture is very important. So have that in your mind, and I hope you guys have revised. Clear? Let's get started. And one sec. So before I get started, I just want to tell you guys, in case you don't have my number, I hope everyone has my number. Just in case you don't have my number, I'm just giving it to you here. It's 80724 83095. This is my number. And if you are an email person and you wish to ask any doubts through email, you can also use this. costingwiz@gmail.com. So everything is in small only, but anyways, it's not case sensitive, so that's why. Just in case you need any kind of for any of your doubt clarifications, you can use any of these three channels. And of course, at times there might be certain doubts that you might not be able to type. What you can do is you can send a voice note. You can just record and tell me this is what it is, and you can maybe send the question, a photo of the question, and maybe you can use a voice note and tell me, sir, this is something that I don't understand in this question, things like that. So any which ways, you have all the means to reach out to me. Ensure that on a daily basis you are progressing along with the class. That is very, very important. That's the only way to learn the subject. Clear? And one more thing, today, I think by today or tomorrow, what I will do is, now if you look at the handout that I've given you today for the upcoming chapter called cost of capital, I would have given a few concepts and a lot of questions will be there. No solutions, because solutions we are going to do it in the classroom. Now this handouts that I'm giving you is a tool for you to learn the subject. We would have covered all the concepts. That is applicable for your examination. So I have taken sufficient care in ensuring that by way of these questions, every concept gets covered. Now, after we finish the class, that is every day when we finish the class, go home, do it once on your own, because if it is costing, it will be lengthy to solve. In case of FM, things are not lengthy. Things are not very lengthy. The thing is, you should know if this is the given data in the question, this is how I need to approach. This presence of mind should be there. It comes only by practice. Do it once again, and then when it comes to questions for practice, what I'm going to do is an open secret. I will share with you the institute study material, the PDF copy, nothing but I have downloaded from your Board of Studies portal, everything. Okay. Then the past RTPs I will give you. Then the past exam questions I will give you. Everything in PDF format I will give it to you. Put it on the group. It is already there in institute website. You can download it if you want. But anyways, I am giving it to you. What you need to do is, then and there, when we complete a chapter, go do it. For example, you know this RTP, right? Revision test paper. In revision test paper, for every attempt, institute comes up with a revision test paper. 1 or 2 months before the exam, they come up with it. Fine, or maybe slightly even before that. What they do is, every chapter, maximum 1 sum will be there, or at times 2 sums might be there. When you are completing a chapter and going to the RTP, 1 RTP, 1 sum. Correct? Suppose you just cumulated till the end. After we finish the classes, you are starting with the RTP. 1 RTP will have about 10 sums or 15 sums. What happened? Someone, can you just mute? Is there a problem here? Who's that? Online folks, am I audible?
Sir.
Yeah. Okay, fine. I think someone is Srivar. Who's that? I don't know. Please, someone mute yourself. Mind voice. Okay. Right. So then and there you finish it. It's a matter of one question. By the time we finish the class, you would have also finished the past RTPs, past exam questions. Things are going to be easy. Life is simple. If you accumulate it, I'm telling you, it is one heck of a task. Overnight FM you cannot understand. So then and there, keep moving parallelly. One biggest luxury you have right now is only 2 classes per week. Correct? Yes, by the time you sit for the next class, you can actually make up whatever we have studied. You can revise till then and then appear for the next class. That's why deliberately Tuesday class are bigger, Thursday class is small, because the biggest class comes after a long break. So day after tomorrow is just a 2.5 hour session. So you have only 1.5 days, you can easily revise. Clear? Deliberately things have been made. I've taken this much care. From your end, all I need is a proper participation in the classroom. Once the class gets over, then and there revise and ensure that you have complete control over the subject. Midnight someone, yeah, busla ukandirukeenga. Hey, yaarra adu? Hey, someone please mute yourself. I don't know who that is. Please just mute yourself. Yes. So very good morning, everyone. அப்போ இவ்வளோ நேரம் ஏன் குரல் தான் வந்துட்டு savage reply. இப்ப நான் உனக்கு என்னவா பண்ணேன்? இவ்வளவு நேரம் நானே என்ன திட்டிட்டு இருந்தேன்னா ஓகே, இனிமே வராதுல்ல, இனிமே நானே வர மாட்டேன். Okay guys, sufficient. Yes, today fun time over, so let's get started. Abdullah conductor anwara naane na kethen. Okay, fine guys, so then and there you revise, and that's something that I wanted to tell you. Have that in your mind, not only for this subject, for all the subjects. Do that. Then and there you revise. Be prepared for the next class. I am not asking you to prepare for the next class or whatever concept I'm going to do, you do it in advance. Abdi sollala. Whatever we have completed, that alone you do. Then and there you do. The power of consistency, you will see it 1 month or 2 months before the exam. You will realize the power. You will know that by then only most of the students will be starting. By then you would have already completed and you will be sitting for revision. That's how it has to be. Clear with this? So on this note, let us get started with today's session. So in the last class, we finished the concepts involved in time value of money, and all this time value of money, the cash flows, discounting and all we saw. And then a long discussion we had on concept called as, come on, IRR, internal rate of return. After that, we started with the segment B, that is valuation of securities. That was very simple. Directly whatever present value, all those concepts that we saw, we just repeated it by way of numerical problems. I think we are left with 3 more questions. Let us quickly finish it off and we will get into the next chapter called as cost of capital, which is a very important discussion. By the way, I didn't forget. I remember I told you guys to do those 3 sums on your own. Did you guys attempt it? Yeah. No. Huh? You guys attempted. I'm not asking did you get the correct answer. Attempt daneda. Please, I can still see many students have admitted. I appreciate your honesty, but I don't appreciate your sincerity. But you should have done it, guys. You should have done it. I am sitting here for you. If I'm ready to work for you, you should also ready to work for yourself, no? Anyways, I will be doing it here. You do it, only then you will know where you're getting stuck. If I handhold you, things will be very easy. But you don't have the luxury of ensuring that the teacher is sitting next to you in the exam hall, no? In exam hall, you need to enter alone. Correct? Today, you know where you are stuck. Then only you will get to know these are the areas where I will make a mistake, and then you will start working on it. Fine. So please, guys, you just certain things, if I tell you, please just simply listen to it. I am telling it to you for your benefit. Okay? So fine. Let's get started. One sec. Yes. Okay. So which sum are we into? I think question number 9. I think there are 3 questions are pending, right? Question number 9, 5 and 6. So I think we started with that debt. So let us finish the debt or the bond or debenture we were doing. So let us finish question number 9 and then go to 5 and 6. 5 and 6 are simple vanilla cases, direct cases, very simple. So let us go to question number 9. Let's get started, guys. This is on handout. And by the way, the handouts that I'm giving you, I asked you to maintain it in a file. Not a use and throw, I told you. Look, this handout stops at page number 2. If you look at the today's handout that I have given you, I assume it is already there on the group. It starts with 3. Why? Because I only told you to cross-reference, no? I told you to cross-reference. In your notebook, reference, give reference to your handout. In your handout, give reference to your notebook. I have taken this sufficient care, but when you are doing the question, you should give the cross-reference. It is a continuation. Yes, it is a continuation. It will only be like that. Clear? Yes? So let's get started, guys. Let's get started with this question. A PSU. What is a PSU? A public sector unit or public sector undertaking. Yeah. So a public sector undertaking is proposing to sell 8-year bond. Bond is nothing but a debenture, correct? Of rupees 1,000 at a 10% coupon rate. What is a coupon or coupon? Interest rate. Very good. Per annum. Obviously, if nothing is mentioned, it's per annum. They've specifically given it. Bond amount will be amortized equally over its life. What do you mean by that? Will be amortized equally. Redeemed equally. Exactly. Someone said. Very good. It will be redeemed equally over the life of whatever 8 years, which means it is not like today the company raises the debenture at the end of 8th year, single shot they will pay back. No, here they are saying every year I will equally pay back. Simple. 1,000 divided by 8. How much is that? 125. Every year, at the end of every year, they will pay 125 plus interest that is pertaining to that year. Next year, another 125 plus interest and so on. Are you clear with this? This is what it means. Clear with this? Certain jargons and terminologies, you should get used to it. Clear with this? Fine. Someone is... Okay. Fine. If an investor has a minimum required rate of 8%, what is the bond's present value? So basically, they have given the discount rate also. Now, in this question, what is the challenge? What is the challenge or what is not directly given? Enna value kudukala? So basically, okay, fine. What is the present value of the bond? No. I'm saying how will you find the value of the bond? 1,000 rupees is the face value. How will you find the present value of the bond? This is nothing but discounting all the future cash flows, correct? Now, how much amount is the cash flow that is happening at the end of every year is not given. We need to find out because the cash flow happening at the end of every year is some principal plus interest. Correct or not? What is that? We don't know. We need to find out. For that, they have given the hint saying that the bonds will be amortized equally over there. The first step is finding out what will be the cash flow for each of the 8 years. Once you find that, simply discount it to the present value. You will arrive at the present value of the bond. Are you clear with the approach to the solution? Answer is just an execution. Answer is just a byproduct. It comes by itself. First, you should know the approach to the solution. You should know this is how it should go. Are you clear with this? Any doubts here? Shall we get started? Shall we get started? And do you guys know this amortization table of loan? Do you guys know this loan? In your hire purchase, you would have studied. Hire purchase, you would have studied. Suppose at the beginning of year 1, 1,000 rupees, company raised 1,000 rupees. At the end of year 1, they repaid 125, correct? Year 1's interest will be calculated on entire 1,000 because 1,000 rupees was utilized for the entire year. Now, the year 2's opening balance will be 1,000 minus 125. How much is that? 875. Now, for year 2, the interest will be calculated on 825 because only that 875. Okay, that amount was only utilized for year 2, correct? That is, in a reducing balance method, interest needs to be calculated, correct or not? Or in other words, only for the capital I utilize for that period, I need to compute my interest. Yes, you guys know this. Hire purchase, CA foundation. Yes, you guys know this. Shall we do it? That amortize. Sorry. CA inter. Okay, fine. CA inter. Loan, basic loan amortization table. Anyways, you guys get it right. So we will do it in this question. There is a simple thing. You need to identify the cash flows, discount it, and you will get the present value. Clear with this? Shall we do it quickly, guys? Shall we do it quickly? I will give you the presentation. We will do it quickly and close it off. Are you all clear with this? Let's get started. Take question number 9. We'll write it right in your class notes. Question number 9. Question number 9. Give a cross reference. It's on page number 2. 2 dane. Give a cross reference. Okay, fine. So please drop the table, guys. Just do as I say. Just do as I say. First write down. First write down. Sorry. Heading. Yes. First write down. Principal repayment. Every year. So how much is this equal to? Rupees 1000 divided by, guys, tell and write, divided by 8. How much is this? Rupees 125. I know that every year I'm going to repay the principal of 125. But is the principal repayment the only cash flow? No. On a diminishing balance method, I need to pay the interest also. Correct? So I need to have something called as a loan repayment schedule or an amortization table. It is generally called, in finance language, it is called as an amortization table. Clear with this? Don't think amortization is nothing but your, the intangible assets writing off. Basically, writing off, diminishing is called as amortization table. Clear with this? Fine. So write down. Please write down. Amortization table. So I will give you the template. Please write down year, opening balance, principal repayment, closing balance, interest. What is the interest rate? Guys, interest is 10%. Then write down cash flow. So basically, let us take this principal repayment, name it as A. Interest at the rate of 10%, name it as B. Cash flow is nothing but A plus B. Correct? Every year the cash flow will be sum total of principal repayment plus the interest payout. Correct or not? Guys, everyone, are you all understanding this? And one more thing, this interest at the rate of 10%. Okay, when we do, we will just do it. Now, you have the respective year's cash flow, right? Wait, have you already come to the end? You've already come to the end. Okay, fine. Okay, fine. I should have told you earlier. See, simple. All these are respective year's cash flow, right? What I can do is, I can just add present value interest factor and I can write present value cash flows. And if I total this is nothing but the value of the bond. Correcta ilya? Or separator, if you want, put that cash flow equation and do it, it's okay. This is an easier way of doing. If you have exhausted the lines or if you have exhausted the limit in the page, maybe you can just bring it down and do it separately. Okay, no issues. Anyways, first let us concentrate till here and then I will walk you through this. No issues. First, guys, I want your participation here. First, let us start with year one. With respect to year one, what was the opening balance? 1000 rupees. Everyone should participate. Guys, please participate. I told you, learn like a child. Don't forget that. Learn like a child. So write down 1000 rupees. Correct? Now, at the end of year one, what was the principal repayment? 125. So how much is the closing balance? 875. Now, this year's interest will be 10% on 1000. It is not an 875. Why? Because entire 1000 was utilized for the entire year. Correct? At the end of the year, I am paying 125. That is fine. This closing balance I am computing because it becomes the opening balance of next year. That's all. But the interest is always calculated on the opening balance because that was the figure that was utilized through the entire year. Whatever I use for the entire year, on that only I should pay interest. Correct? Logically, it is correct. Don't mug up. Logically, is it correct? Yes. Maybe you can write it here. You can also write this is 10% on opening balance. Maybe you can just squeeze it and write just because you had this doubt. So guys, use the calculator. How much is it? Or you shouldn't be using calculator for this. How much is it? Yes, 100. So at the end of year one, what is the cash flow happening? I repaid 125 plus 100. How much is it? 225. First year's cash flow is sorted. correct? Second year, this 875 becomes the opening balance of second year. Then the same 125 gets repaid. What is the closing balance? Guys, 750. 750, correct? Now, interest at the rate of 10% on opening balance, 87.5. What is the cash flow? 125 plus 87.5. How much is that? 212.5. Correct, guys? Yes. Next, year 3. Year 3. So, how much happens? What happens here? Year 3. So, this 750 comes in here. This becomes the opening balance. Same 125 gets repaid. How much is it? 625. Correct? So, 10% interest on 750. How much is it? 75. So, your total cash flow at the end of year 2 is 125.75. How much is it? 200. Is everyone following? I don't want anyone to copy it. Do it on your own. This is only for a reference. Do it on your own. Next, year 4. Opening balance 625. Repayment same 125. So, what is the closing balance? 500. Interest calculate on opening balance 62.5. Cash flow arising at the end of year 2 is 125 plus 62.5. How much? 187.5. Next, year 5, opening balance 500. The closing balance of previous year is opening balance of the current year. Same 125 gets repaid. How do we know? They have only told us amortized equally. Then how much is the balance? 375. Here, what is the interest on 500? 50 rupees. So the current year cash flow 125 plus 50, 175. Correct? Then 7th year 375, 125. How much is it? Sorry, 6th year. My bad. Sorry, 6th year. So tell me how much is this? Is it 250 then? Correct. So interest is calculated 10% on 37, 375, 37.5. So 125 plus 37.5. How much is that? Sorry, 162.5. Okay, done. Next, 7th year, 250 opening balance. Repaid 125, closing balance 125, interest 10% on 125 is 12.5. The current year cash flow is sorry. My bad. I'm sorry, guys. I'm sorry. My bad. I just made a mistake here. So this interest should be calculated on opening balance. It is going to be 25. So here the current year cash outflow is 125 plus 25, which is going to be 150. Last year, it is going opening balance 125. I have repaid the entire 125. Balance is 0. The current year interest is 10% on the opening balance of 125, which is 12.5. The total cash flow is 125 plus 12.5. How much is it? 137.5. Yes, are you all clear with this? Are you all clear with this? Is everyone able to follow this? Anyone has any doubts here? Anyone has any doubts here? Now, basically what we found out is we have 8 different cash flows. 8 different cash flows. Unequal cash flows are there. So, respectively, if you multiply it with the present value interest factor, or this is nothing but 225 divided by, what is the interest rate here? I mean the discount rate, 8%. 8% is a discount rate. So can I say 225 divided by 1.08 to the power 1 plus 212.5 divided by 1.08 to the power 2 and so on. Correct? That is basically I am discounting. Instead of doing this, since I already have this table, can I directly put the interest factors here, multiply the two, and finally what I will get is the present value of all future cash flows. Correct or not? Correct or not, guys? Yes, are you all able to understand? If you have exhausted the space here, no issues, you need not worry about it. What you can do is, maybe you can come down and separately put another column. Write down the present value cash flows the cash flows, you just write it, then present value interest factor and present value of cash flows. Are you clear with this? You can just repeat the last 3 columns again, you do it separately and automatically you will get it. Clear with this, guys? Is everyone understanding this? Okay, now present value interest factor at the rate of how much percentage? What is the discount rate? 8%. Correct or not? This 10% is the interest rate used for what? Calculating the cash flow. This 8% is the discount rate used for what? Arriving at the present value. Yes, are you all clear with this? Yes. So now you can go to the table or you can do it by yourself. This you can arrive at the figures by yourself. Yes or no? How will you do it? 1 divided by 1.08 is equal to some number will come. Write it. Once again is equal to, write the second column. Once again is equal to, write the third column and so on. Can we do it quickly? Yes. So come on, guys, tell me, what is it? 0.9. Yes. So first 1 divided by 1.08. How much is this? 0.926 click is equal to once again 0.857, then is equal to once again 0.794, then is equal to once again 0.735 is equal to once again 0.681, correct, is equal to once again 0.630, then is equal to 0.583, then is equal to 0.540, correct? Yes. Why are we doing all these things? Because 225, 212.5, 200, these cannot be added as such. Monkeys, donkeys only. Yes, it cannot be added as such. Make it comparable using the present value technique and do it. Clear with the concept. Every time you do, tell this to yourself. Why can't I add the cash flows arising at multiple intervals? Because these are not comparable as such. The value of money changes over time. Hence, to make them comparable, convert everything into today's value. Then automatically you can add it. Are you all clear with this? Yes. So now tell me, how much is this? I want the figure. I'm relying on you. Tell me, first figure. 2. 208.35. Then multiply the 2. 182.18. Then 1125. Whatever it is, decimals you just round off. Next. 158.8. Okay, next. 137.81. That's all, only 2 decimals I want. Next. 119.10. 175. Okay, 175. Okay, fine. Next. 102.375. Okay, next. 87.45. Next. 74.25. Total it up. If you used that M plus, by the time you calculated everything, MRC, one button, you would have got the total. Smart way of doing it. Yesterday in the class or in the last class, I taught you this M plus MRC, Then and there, when you are doing this, arriving at the figure, simply click on M plus. At the back end, it will be calculating for you. By the time you arrive at the 8th year's figure, one button MRC, you will get the total. Or maybe you can also use the concept, the GT button also you can use it. Guys, do some smart working, because calculation, it should be in seconds, you should get it. We are all finance students, so we should be experts in using all this calculator. Yes, tell me the figure. 1070.32. Are you clear with this? So this is basically the present value of the bond. Are you all clear with this? That is, the present value of a particular instrument is nothing but whatever is the future value I get, discount it, and I will arrive at the present value of that. So that is only the value as on date. Are you all clear with this, guys? Is everyone understanding this? Yes, guys. Have you all completed? We have already taken a lot of time on this. Are you all clear with this? Question? So whenever they have given the word amortized, it means it is getting repaid. It is another word. Learn the finance jargons. People say, big companies, if you go to big meetings, meet with big entrepreneurs, they will say, what is our top line? What is our bottom line? Abdina enna? Top line means sales. Bottom line means profit. In the terminologies they will use. Similarly, if you see, the amalgamation la mudjuda. Amalgamation la ungalku overa. Amalgamation la, how they call it is, they call it as, in final you will be studying this Ind AS and all, they call it as business combinations. Anga buscom nu solluvaanga. Generally in local, in colloquial way, they say buscom. It means business combinations. Look at the word they are using. Two business are combining, no? They call it as business combination. These are certain accounting finance terms that generally people use. So if you know this, if somewhere you just see all these words, the news or someone is saying, you will be able to relate. Okay, so they are saying all these things. Okay, so whatever we have studied, they are actually using the top line, bottom line is a very, very regularly used words. Top line, bottom line for sales, turnover and profit, they use it very regularly. Anyways, coming back, so this is the present value of the bond, or B0, or the present value, the current market price, or the present value of the bond. Are you all clear with this, guys? Are you all clear with this? What we did, simply we found out the cash flow arising at each of the 8 years and discounted it using the discount rate given in the question. That's all we did. But the calculation of the cash flow was an issue here because we had to put up a loan amortization table, loan repayment schedule to find out how much is getting paid at the end of every year. Are you all clear with this? Yes? You have a doubt? Yes. In the table, கொடுக்க மாட்டாங்க. அப்புறம் மார்க்கும் கொடுக்க மாட்டாங்க. இந்த டேபிள் கொடுத்தா என்ன இருக்கு பண்றதுக்கு இதுல? In the entire sum, see, finally you are saying, will they give me this table? It means that you are asking, look. If they give you the table, once again, if they give you this table, what will happen is, they will give you all these figures. Correct? You just need to you just need to multiply and arrive at it. Okay, fine. In the Madri question, generally, if it comes, generally it is basically for testing you on how you are able to arrive at the loan amortization, how you are able to arrive at the cash flows. Angada main test. If they give maybe in a comprehensive sum, guys, please. So in a comprehensive sum, if there are other aspects involved in that sum, and if the test is more on that, in that case, maybe they might be giving you all these things. But ideally, otherwise, you be prepared for this, no? You be prepared for this. You know, if they use the word amortization, you should know what to do. Are you all clear with this, guys? Beyond this, let us not spend time here. Let's get going to the next sum. Are you all clear with this? Shall we proceed? Yes. So let's move to the next one. Let's move to the next one. So what is the next question? I think it's question number 7. Oh, sorry. Yeah, 5. Valuation of redeemable preference shares. First, you tell me, guys. First, you tell me, what do you mean by a preference share? I don't want in the booklet definition. Tell me what you know by preference shares. Sorry, hybrid of equity and debenture. Fine, good. Interest. Dividend. Any other thing? Whatever you know, you tell me. No, please, not more than a few seconds. Okay, so the word preference by itself means what preference you get? What preference you get? You get preference over when it comes to preference over equity. So these guys are also owners or shareholders, correct? They are shareholders. Then why are they called preference shareholders? When it comes to payment of dividend, they get the preference. When it comes to in the event of liquidation, theoretically, generally a company goes on a going concern assumption. In case the company is winding up, then these guys get paid first and all these things are there. But on the flip side, they don't have any voting powers. They don't have a say on what is going to happen in the company and all. Exceptions are there. There is something called as participating preference shares, cumulative preference shares. We will see it later. But generally, what is the basic quality of a preference shares? Every year they get paid a fixed dividend. Correct? Yes or no? Yes. It will not vary. No. They will agree. Look, I'm going to pay you 10%. 10% on what? 10% on what? On what? On face value, par value. Yes, correct. So this is as good as it is going to be more or the same as your debentures or your bonds. Correct or not? Interest ke badala dividend. That is one small aspect to which we will see today in the cost of capital chapter. But for the time being, you understand when a company issues preference shares, every year they are committing a dividend, a fixed amount of dividend. Right at the time they are issuing itself, they will say it's a 9% preference share, 10% preference share, meaning 9% on face value. That will be the fixed outflow that will be happening on the company side. Are you all clear with this? Yes. And in the now, can a company issue irredeemable preference shares? Can a company issue irredeemable preference shares? Sorry. அது நான் சொன்னது டிபெஞ்சர்ஸ்க்கு ரெண்டு கம்பெனி கொடுத்தாங்கன்னு சொன்னது டிபெஞ்சர்ஸ்க்கு ஃபார் preference shares can a company issue irredeemable in India yes only banks and financial institutions can do it not your regular companies cannot do it. One second, let me just verify it. Yes, only banks and financial institutions can do it. They are allowed as per RBI guidelines, but for that no one else can issue irredeemable preference shares. Are you clear? These are some add-ons. If you want, you can just catch up running notes there, then and there, and close it off. It is not required from an examination perspective. Since I took this, I am just giving you a value addition. As simple as that. So basically, you understood the quality of a preference shares, correct? So there is a fixed commitment every year. The period can be either defined or it need not be defined. Are you clear with this? Are you clear with this? So these instruments vary in, depending on the country in which you are operating, these things vary. For example, let's say I want to buy 1 share of Tata Steel. Can I buy 0.5 share of Tata Steel? In India, you cannot, but in US, you can, because it's called as stocks. There, the concept of stock comes in. Here, colloquially, we say share market, stock market, both are one and the same. Here, in multiples of one only in India, you can buy. Whereas if you go to the US, they will say, today you can buy, let us say, 1 share of Google. You know what is 1 share of Google is quoting at about, I don't know, in Indian value, it will be definitely more than 4-5 lakhs. One share in Indian value, correct? Can you be an owner of Google, or you want to buy a share of Google? Is it possible? Yes. How much money you have? 100 rupees. Yes. Proportionately, they will give you a percentage, a small 0.05 percentage of 0.05 of a share, 0.05 of a share, you can buy it. Yes, this is there in US. The concept of fractional shares is there in US. In India, it's not there. Clear? So all these financial things and all these securities, it varies from country to country. In India, the regulation is such that preference shares, irredeemable preference shares can be issued only by banks and financial institutions. But if it is given in the question, simple, sir, for exam, what should I do? If period is not given in the question, assume it to be irredeemable. As simple, perpetual. Are you clear with this? Yes. Are you all clear with this? With this background, shall we just get into this? Yes. Fine. So go to question number 5. So on page number 2 on handout 1. Mr. X is considering purchasing a 12-year 10% rupees 100 par value preference share. The redemption value of the preference share on maturity is rupees 120. Mr. X's required rate of return is 10.5%. Basically, the discount rate is given. Calculate the current market price. So, every year, how much amount will the company pay as dividend? How much amount? 10 rupees. How you got 10 rupees? It is 10% on 100. So, 10 rupees they will pay during the life. Is the life given? Yes. 12 years. For each of the 12 years, the company will pay 10 rupees every year, and at the end of the 12th year, they will repay the original amount of how much? Sorry, they will repay, and with the premium, they will repay 120 rupees. Correct or not? Correct or not? So, can I say 10 rupees I get equally over the span of next 12 years? Can I say the present value or the current market price of the preference share is nothing but 10 rupees into present value interest factor annuity of 10.5%, how many years? 12 years. Plus, at the end of the 12th year, I will get 120 rupees into what? Present value interest factor of 10.5%, 12 years. Correct or not? Correct or not? Are you all clear with this? If you do this, all your future cash flows discounted using the discount rate given, you will arrive at the present value or the current market price of any security. This is the basic thing that we saw. Are you clear with this? Shall we just quickly do it, guys? Shall we just quickly do it? Or if you want to prepare a cash flow equation, 10 divided by 1.105. Yes. So to the power 1, so 10 divided by 1.105 to the power 1 plus 10 divided by 1.105 to the power 2, and so on it goes till the 12th year. In the 12th year, apart from the regular 10 rupees, you will also get 120 divided by 1.105 to the power 12. Are you clear with this? This is your cash flow equation. Is everyone understanding this, guys? Anyone has a doubt here? Is everyone clear? Shall we just do it quickly? Yes, let's get started. So write down, this is question number 5. The question number 5. Fine. Anyways, you just write this down. So the current market price, they have asked you, right? The current market price is equal to 10 divided by 1.105 to the power 1 plus 10 divided by 1.105 to the power 2 plus 10 divided by 1.105 to the power 3 plus so on it goes, and at the end of the 12th year, apart from the 10 rupees that you get, you will also get back 120 divided by 1.105 to the power 12. Correct or not? So the end of the 12th year, you will get, maybe you can write this, 10 divided by 1.105 to the power 12. Apart from the interest payout at the 12th year, you will also get your original principal, and that principal they are paying 120. Yes, are you all clear with this, guys? Or this is nothing but, please write down 10 into present value interest factor annuity of 10.5 percentage for how many years? 12 years, correct? 12 years plus 120 into present value interest factor of 10.5 percentage, comma 12 years. Yes, are you clear with this? Now in this case, you guys can automatically find out the interest factor. Pick your calculator. You should not wait for me. You should not wait for me. For that matter, you should not wait for anyone in life. Be self-reliant. Be self-reliant. Pick it up. Do it on your own. That's your duty. Come on, let's do it. Do it on your own. I'm not going to do this. I'm going to pick the answers from you. Come on, tell me the interest factor alone first. So 10 into, what is the interest factor annuity? You guys know how to do it. Do it. Tell me, what is the interest factor annuity? 6.6499 or 6.65. Yes. Plus, how much is it? 120 plus 120 into, what is the present value interest factor? 0.302. You can just round it off. 3017, 302. Yes, correct. So how much is this? Correct. Any issues here? Guys, are you all doing it? Anyone having a problem in knowing how to do? Is anyone struggling here? Please do it. Please do it. Please do it. So tell me, how much is this? 665 less 66.5. 66.5 plus idevlo 36.24. How much is the total? 102.74. Are you all clear with this? As simple as that. This annuity table, anyone is having a problem? Anyone is having a problem? 1 divided by 1.105 is equal to, first what you should do in case of annuity, click MRC twice, clear the memory. Now what you need to do, 1 divided by 1.105 is equal to M plus, like that 12 times you need to do. When you click on MRC, you will get the figure. That is sum total of the aggregation of the present value interest factors for 12 years. Correct, guys? We have spent a lot of time on this. Guys, anyone having an issue? Please respond. Please respond. You guys are fine with this? Yes. Okay, so shall we move to the next sum? So quickly, let's go to the last sum. You got it? If you have further issues in using the calculator, maybe after the class you can just get in touch with me. Yes, come on. Question number 6, the last sum in this particular chapter. A preference shares pays rupees 10 as dividend annually up to what? Perpetuity, which means what? Irredeemable preference shares. I told you in India only banks and financial institutions can do it. What is the value of preference shares if the cost of preference share is 10%? Now, what is this? Which model is it? Hello? Equal amount to perpetuity, no? Equal amount to perpetuity. How will you calculate the present value? Annual cash flow divided by the discount rate. Correct? Minus. Growth guys, perpetuity, indefinite period. I told you only 2 options are there. One is constant cash flow, equal cash flow up to perpetuity, or growing cash flow up to perpetuity. Correct? So constant cash flow up to perpetuity, what is the present value formula? Annual cash flow divided by discount rate. Correct? In case of growing cash flows up to perpetuity, what is the cash flow at the end of year 1 divided by discount rate minus growth rate? Correct or not? In this case, it is a growing model or constant model? Constant model. So what should be the formula you use? Simple, annual cash flow divided by your discount rate, whatever is R or whatever. 10 rupees divided by 0.10. How much is this? Rupees 100. Quickly write this and close it off. Please quickly write this and close it off. As simple as that. It's very simple. This is nothing but 10 divided by 1.10 to the power 1 plus 10 divided by 1.10 to the power 2. It goes on till infinity. This is the cash flow equation. In this case, what is the logic for this formula? I told you. Sum of infinite geometric progressions, A divided by 1 minus R. I just did it in a blue ink and showed it to you, the proof also, how this formula came. Correct? Yes, guys. Are you all clear with this? Are you all clear with this, guys? Is everyone clear with this? Yes, done. Done. So let me just recapitulate whatever we have done in this chapter till now, whatever we have done it. The reason why I'm recapitulating is, don't think every chapter I will be doing it. This chapter specifically I'm doing it because I want to, whatever we have seen in the previous 2 sessions, all of that will be merged in today's session, and today's session we will take it forward to the next level. That is the reason I just want to set the context and do it. Are you clear with this? So basically, in the till now in time value of money chapter, we have seen that cash flow arising at year 1 is not equal to cash flow arising at year 2, or in other words, 100 rupees I give you today or 102 rupees I give you at the end of year 1, which is better? You cannot arrive at a decision as it is, because 100 and 102 are not comparable as such. So what we do is we use time value of money techniques to actually equate the two or make the two comparable, and then operate on it to arrive at some decision making. Are you clear with this? Now there are 2 time value of money techniques. Future value, present value. Future value, 1 or 2 sums. I showed you some illustrations and I stopped it there. Throughout major portion of this subject, we will be seeing they will give you the future cash flows. How do you discount it and arrive at the today's value of tomorrow's money? Clear? That is multiple cash flows they will be giving. You need to discount and arrive at the present value of that. That is what we've been seeing. Now, how can you do it? How can you do it? Broadly, single cash flow is very simple. You just use the formula. Present value is equal to future value divided by 1 plus R, the whole power n. Simple. When it comes to sum of multiple cash flows, broadly you can classify it into 2. Definite period, indefinite period. Correct? In case of definite period, further 2. Multiple unequal cash flows, multiple equal cash flows. Both are same in terms of context. The respective year's cash flow, you need to use the present value interest factor. What is present value interest factor? 1 divided by 1 plus R, the whole power n. That if you do it for the respective year, that is called as present value interest factor. So basically, every year's cash flow, if you multiply it with the present value interest factor, you will arrive at the present value. In case of equal cash flow, you can take the cash flow common, correct, because it is equal. And if you sum total of all the present value interest factor, let's say for 5 years, 6 years, that is called as present value interest factor annuity, which there is a table readily available for us. If it is given in the exam, you can directly make use of that table. Clear with this? Going to the other side of the chart. What is the other side of the chart? Indefinite cash flow, indefinite cash flows. Two possibilities, only 2 possibilities are there. One is equal cash flow up to perpetuity. What is the formula to calculate the sum of equal cash flow to the perpetuity? Annual cash flow divided by discount rate. Simple, correct? In case of growing cash flows up to perpetuity, cash flow at the end of year 1 divided by discount rate minus growth rate. All the derivation for both this indefinite cash flows, the derivation is sum of infinite geometric progression series A by 1 minus R. Derivation is done. Are you all clear with this? After this, we saw one very important area called as IRR. Very important. That's the basis of finance. So what is an IRR? Basically, I told you that in any finance transaction, there will be both inflow and outflow. Now, from your viewpoint, you are going to the bank and you are opening an account for fixed deposit. Initially, T0 means what? Today. That is year 0, beginning. Yes. Year 0, you will give the bank some money. Correct? That is an outflow. But once you give this, it will be followed by a series of inflow. Correct or not? Correct or not? Yes. Every year, bank will pay you interest. At the end of maturity, they will also repay back your principal. Correct? So, from the viewpoint of the investor means the person who is parking his funds. Correct? There is an initial outflow followed by a series of inflow. Correct? Flip the same transaction. If you look at it from the bank's perspective, Initially, there is an inflow. They are taking money from you, correct? And every year they need to pay you the interest, and at the end of the tenure, they also need to repay back the principal. So from the bank's perspective, there is an initial inflow followed by a series of outflow, correct? So any complete financial transaction will have both inflows and outflows attached to it. Yes, and the rate that equates the present value of inflows with the present value of outflows is called as the IRR, internal rate of return. That is nothing but the discount rate that equates my present value of inflow with my present value of outflow, or present value of outflow with my present value of inflow. Whatever it is one and the same. Are you all clear with this? Are you all clear with this, sir? Why should I equate it? For example, let's say you go to a bank, and the bank today at the end of year one, they are paying you 10 rupees interest. Simple. Forget this banking transaction as such. I'm just telling you, you are parking your money somewhere. You are parking your money somewhere. Let's say you parked 100 rupees. Let's say you parked 100 rupees. How much you parked? You parked 100 rupees. Correct? You made a profit of rupees 10. Correct? Correct, guys. Let's say you entered the share market. Simple. You entered the share market. 100 rupees investment amount. You made a profit. 1 year you made a profit of 10 rupees. What is your return on investment? Return on investment. What is the formula? How much money have I got divided by how much money have I paid? That is, I earned 10 rupees after investing 100 rupees. So this is how much can I say my return? My return is 10%, correct? Basically what you are doing, this is an inflow, this is an outflow. You are matching the two and you are arriving at a return, correct? If it is a single cash flow, it's very simple. In case of multiple cash flows, there is no clear-cut formula for this. That's why we use the IRR technique. Or in other words, that FD example I took, in other words, can I say this IRR you do from the viewpoint of investor, it is nothing but the return he effectively earns. Yes or no? Agreeing with me on this, the return he earns. Or flip it on the other side, can I say this is nothing but cost from the viewpoint of the bank? Yes or no? Yes or no? Because what is the return of the investor is the cost from the viewpoint of the company. Yes or no? Yes or no? And this 10% discount rate is called as the IRR. If you look at it from the perspective of investor, I call it a return. If you look at it from the perspective of the company, it is called as a cost. And that brings us to the next chapter called as cost of capital. And cost of capital is always a percentage. Remember, cost you cannot bring it in absolute term. Let us take an example. Let's say two of us entered into the share market. This is, let's say, Ganesh and Nanda. Both of us entered into the share market. Now we both entered into the share market. Let's say I made a profit of, let us say, 50,000. Nanda made a profit of rupees 500. Who is better? Guys, answer. Please answer. Who is better? Yes. Now, based on this data, you say, yes, sir, you are better. Correct? But based on this data, absolutely. But what I'm trying to convey is, you can't take a meaningful decision absolutely. The amount that I had invested, let us say I had invested 5 lakh rupees to make a profit of 50,000. But you know what Nanda did? He invested only 500. Over and above his original 500, he made a profit of 500. What is his return? His return is 100%. What is my return? 10%. Now you tell me who is better. Now you tell me, hands down you will say, Nanda is better. Correct or not? So always remember, absolutely you cannot take a meaningful decision, because when you establish as a percentage, you will know. What do you mean by 10%? For every 100 rupees I invested, I am earning 10 rupees. Correct? So only if you establish it as a percentage, two options are comparable. That brings us to the next chapter called cost of capital. Always remember, cost of capital is a percentage, and this cost of capital is nothing but whatever discount rate that we saw till now, no? The discount rate for arriving at the present value, the discount rate and all we saw, right? The discount rate we saw, that discount rate is only cost of capital. From the viewpoint of company, we are looking at it, and hence we call it as cost of capital. Are you all clear with this, guys? Are you all clear with this? So cost of capital is nothing more than discount rate, and look at it from the viewpoint of company. Are you all clear with this? Yes, is everyone clear with this? Sometimes data will be given from the perspective of investor. Data will be given from the perspective of investor. When you do something from the perspective of investor, you call it as a return, correct? Now, company's data is not given. Data is given from the perspective of investor. You arrive at his rate of return, correct? And you say that whatever is his return is my cost. Yes. So based on the data available in the question, we can tweak it here and there. Now I told you what is the return from the viewpoint of investor is the cost from the viewpoint of company. Of course, this is subject to a few exceptions. As we enter into the subject, as we enter into the chapter, I will tell you here and there where these exceptions will apply. Are you all clear with this? Are you all clear with this? First, are you all able to understand the introduction? See the slow transition we moved into the next subject. This is the core of finance that we are entering into. Are you all clear with this? Yes, guys. So whatever we have studied till now, today we will be connecting all the dots and we will be seeing what is what in this particular chapter.